Hello, welcome to IAS 8 tutorial 1. My name is Axel Mafundemacha. Today we'll be dealing with prior period errors from IAS 8. The objective of the prior period error note is to correct errors in prior year's financial statements. Prior year financial statements would have been published with errors, and users would have made decisions based on those errors. Current year corrections do not require a disclosure note, as those can be corrected using journal entries before publishing. Prior period errors are omissions from and misstatements in an entity's financial statements for one or more prior periods. These errors may result from mathematical mistakes, mistakes in applying accounting policies, oversights or misinterpretations of facts, and fraud. The general principle in IAS 8 is that an entity must correct all material prior period errors retrospectively in the first set of financial statements authorized for issue after their discovery by restating the comparative amounts for the prior periods, or if the error occurred before the earliest prior period presented, restating the opening balances of assets, liabilities, and equity for the earliest prior period presented. Disclosures relating to prior period errors include the nature of the prior period error, for each of the prior periods presented to the extent practicable, the amount of the correction for each financial statement line item affected, and for basic and diluted earnings per share. The amount of the correction at the beginning of the earliest prior period presented, if the retrospective restatement is impracticable, an explanation and description of how the error has been corrected, and financial statements of subsequent periods need not repeat these disclosures, as these corrections would have been made in the current year. Now we deal with an example. On 31 January 2011, Baobab Limited received an amount of $345,000, VAT included, from a customer for services that were only rendered during June 2011. The accountant recognized the $345,000 as revenue in January 2011 and did not allocate the VAT of 15% to the VAT output account. The result was that the $345,000 was included in revenue for the financial year ended 28 February 2011. For tax purposes, the $345,000 was taxed in the financial year ended 28 February 2011. Zimra indicated that they will reopen the 2011 assessment to correct the amount of VAT that was incorrectly included in taxable profit. The figures in the trial balance have not yet been adjusted to account for the correction of the accounting error. Ignore implications of penalties or interest on the late payment of VAT. Required: prepare the prior period error note for the financial year ended 29 February 2012. So the first thing that you do when you're attempting a prior period error note question, you need to map out what actually happened. So the first thing, the accountant recognized the entire revenue of $345,000, including the VAT. So that's the first journal entry that you're going to enter under what happened. And there's the tax relating to that. Always remember, when there's a profit or loss entry in your journals, there always has to be a tax expense or deferred tax journal entry following it. And then you map out what should have happened as your other journal. So, what ideally the accountant should have debited bank with $345,000, credited deferred revenue with $300,000, since this service is only being performed 6 months later and not at the date of receipt of the $345,000, and credited VAT output of $45,000. deferred tax of 77,250 and a tax expense of 77,250 as well, based on the 300,000 times 25.75%. The correcting journal entry is going to be the differences between what should have happened and what actually happened. So your revenue is still going to be is going to be reversed. The 345,000 is going to be a debit. Credit deferred revenue, and you credit VAT output account. And then you adjust your deferred tax and your tax payable, and you credit your tax expense. The first thing that you do once you're done with your what happened, what should have happened, and the correcting journal entries, the first thing that you do in your prior period error note is stating the nature of the error. Now, you do not need to go into detail discussing things like VAT implications on late payment, such as interest and penalties or whatever. Just mention that there was an error in recording the revenue and there was an error in recording the VAT, and then you continue. After that, you map out your changes. So the decrease in revenue of 345,000, like we did in our correcting journal entry, and your decrease in income tax expense of 88,834. Next step, you continue with your correcting journal entries, increase in revenue received in advance or deferred revenue, which you got from your prior period, from your correcting journal entries, increase in VAT payable from your correcting journal entries again, increase in deferred tax asset, and a decrease in current tax payable. Ideally, your movements in your profit or loss should match your movements in your equity. So it should balance out. As you can see, your decrease in profit is 256,162. And your decrease in equity is supposed to be the same as well. For practice, please refer to Level 1, Module 1, Question Bank, Question 8 on page 350. Thank you.